Hello friends, IAS 17 was the accounting standard that was applicable to leases, which was originally issued in 1982 and subsequently reissued in 97 and 2003. However, from 1st January 2019, IAS 17 has been superseded by IFRS 16. This video is intended to provide an understanding about the concepts of lease accounting and the accounting standards that are applicable to lease accounting. Although IAS 17 has been replaced by or superseded by IFRS 16, I feel that we should have a look at IAS 17 before moving on to IFRS 16 to better understand the concepts. So, in today's video, I have created an imaginary classroom to understand these concepts further. So, shall we proceed to the classroom?
Good morning, students.
Good morning, sir. Hello, sir. As discussed in our previous class, could you please let us know further about lease accounting standards?
Of course. Today, we are going to discuss about lease accounting and related international accounting standards. In between, we shall also be getting expert opinion from Krishna to help us further understand the discussion points. So, what is a lease?
A lease happens when the owner of an equipment or property gives it to another person for his use and for an agreed rental.
Impressive. As pointed out by Reena, a lease is generally an agreement by which the owner of an asset, who is called as a lessor, transfers the right to use this asset to another person, called as lessee, for an agreed consideration. For example, James has a truck that he lets to ABC company to use in their business for 2 years at a monthly rent of $1,000. Before diving into the financial reporting standards of lease accounting, we should address the following question. Why do we need a financial reporting standard for lease accounting? The absence of an accounting standard for leases means that a company can own an asset without showing it in the financial statements, which is generally referred as of the balance sheet financing. In other words, the company can still own the asset without showing the asset, as well as the loan against it, in their financials, and it may just account the lease rentals as an expense. Such methods could be useful for companies to keep their debt to equity ratio low in case if they have loan covenants. Now, let us move on to the related financial reporting standards. The financial reporting standard that is now relevant for lease accounting is IFRS 16. However, before visiting IFRS 16, we should have a look at IAS 17, which was the standard that was applicable for lease accounting before the introduction of IFRS 16. IAS 17 distinguishes a lease into two types for accounting and financial reporting purposes: a finance lease and an operating lease. A finance lease is more like the sale of an asset from one party to another, and an operating lease is generally like a rental agreement for a shorter period. Now, how to distinguish between a finance lease and an operating lease under IAS 17? If a lease agreement transfers the major risks and rewards of an asset to the lessee, then it can be considered as finance lease, otherwise it should be treated as an operating lease. Thus classification should be made at the inception of the leases. We may consider a lease as a finance lease under the following circumstances. May I also call Krishna to throw some light on this topic. If the lease transfers the asset to the lessee by the end of the lease term, then it is a finance lease.
The first point. The lease transfers the asset to the lessee by the end of the lease term. So in that case, it has to be a finance lease.
If the lease has an option for the lessee to purchase the asset at a price substantially lower than the fair value, and at the inception, it is almost certain that this option will be exercised, then it is a finance lease.
Now, if the lease has an option for the lessee to purchase the asset at a price substantially lower than the fair value, and at the inception it is almost certain that this option will be exercised, then this should be classified as a finance lease. Now, let me explain with an example. Imagine that the lease has an option for the lessee to purchase the asset at a price of $10,000 by the end of fifth year, and you expect the leased asset would have a value of say 15,000 or 20,000. Now, at the inception of the lease, you are sure that the lessee would exercise that option, because the leased assets fair value, estimated fair value at that particular point is 15 or 20,000, and the lease has gives the option for the lessee to purchase this particular asset as at a price which is substantially lower than that fair value. So in that case, this needs to be classified as a finance lease.
If the lease term is for the major part of the life of leased asset, then it is a finance lease.
Now, if the lease term is for the major part of the life of the leased asset, so this is almost clear, but let me explain once again with an example. So if you are leasing an asset which has got an economic life of say 10 years, and the lease term is for say around 8 years or 9 years, then it is almost close to the economic life of the asset, and it has to be treated as a finance lease.
If the present value of minimum lease payments is close to the fair value of the asset now, then it is a finance lease.
This point is a bit complex than the other points. If the present value of minimum lease payments is close to the fair value of the asset now. So here the point to stress is present value of minimum lease payments. I'm not sure if all of you are aware, but some of you, if you would have gone through the financial management subject, would be aware of about the discounted cash flow techniques, net present value techniques, etc. However, to understand it in a basic way, I will explain with an example. Imagine that your lease is for 2 years, and you both the year the lease payment is 10,000 USD. Now at the first year you're getting 10,000 USD. Now at the second year again you are getting 10,000 USD. But the 10,000 USD what you get at the second year doesn't have the same value as 10,000 you are getting now, right? For example, if you go to a bank, they will charge you interest, right? And there are inflation factor to be considered, interest rate factors to be considered, etc., right? So what you get after 1 year is not having the same value as what you get now. For example, 10,000 what you get at the next year is not having the same value as the 10,000 what you get now. Now imagine that 10,000 what you get after 1 year is having a value after considering the interest rate and discount factor or inflation rate, whatever it is. You are at that particular 10,000 is having a present value, means at the current year it is having a value of 9,000. So the minimum lease payment, total of minimum lease payment is 10,000 plus 9,000 what you're going to the value of 10,000 what you're going to get after 1 year, which is 9,000. So total minimum lease payment is 19,000, and imagine that your assets value is 20,000 at present fair value. The market value is 20,000. So in that case, this 19,000 is so close to 20,000, right? In this particular case, you need to classify this particular lease as finance lease. I hope you all have got a bit of the concept of present value of minimum lease rentals.
Leased assets are of specialized nature that only the lessee can use the asset. Then it may fall under finance lease.
If the leased assets are of specialized nature that only the lessee can use the asset. Let me explain with another example. Imagine that you are leasing out an equipment which is used for the manufacture of helicopters. and in your region there is only one helicopter manufacturer, which is your lessee. So you don't have any other client for letting out this equipment, right? There are no helicopter manufacturers in your region. So under this circumstance, you may classify this particular lease as a finance lease. Now let us talk about the accounting of leases. First, we will go through the accounting of finance lease in lessee's books. So, how to recognize this finance lease at the initial point? First, we need to arrive at the lower of fair value of asset or present value of minimum lease payments, which is lease payments discounted at the interest rate implicit in the lease, plus any direct cost involved in this, such as surveyors fees, consultant fees, etc. So to make it clear, so you have the fair value of the asset now, right? Which could be the market value, right? Now there are some minimum lease payments to be paid under the lease, right? For example, 10,000 USD every annum. Now, as I said earlier, you need to discount this 10,000 to be paid every year to arrive at the present value. For example, 10,000 now is 10,000. 10,000 to be paid after 1 year. Consider it as 9,000. 10,000 to be paid after 2 years. Consider it as 8,000. So add up all these values plus any direct cost involved in this particular lease. For example, the surveyors fees or consultant fees. Add up this to these two and compare it with the fair value we arrived at earlier, that is the market value. Now if the value of the lease to be recognized is the lower of fair value or the second value, which is the minimum lease payments plus the direct cost, okay, that has to be the value at which the lease has to be recognized at the initial point. And what will be the entry? So it's a leased asset. You need to recognize it as a fixed asset in your balance sheet or statement of financial position, considering you as the lessee. So entry will be debit property, plant and equipment, which is a fixed asset with the above value earlier we arrived at, and credit lease liability with the above value, and this has to be split into current liability as well as non-current liability. Okay, now we'll talk about subsequent measurement of this particular lease in lessee's books. So the asset which we recognized as property, plant and equipment needs to be depreciated, right? It has to be depreciated in line with the other assets which are owned by the lessor. Okay, this is a leased asset, but there are some other assets, similar assets. There could be similar assets owned by the lessee. So in line with that, for example, the other assets might be depreciated on a straight line basis or a reducing balance basis. The same method has to be adopted for this particular asset also. Now the period and over which it has to be depreciated is should be either should be the lower of lease term or the economic life of the asset. For example, if the lease term is for 4 years and the life of the asset is for 5 years, you need to depreciate it over 4 years and vice versa. So how the entry has to be accounted? Debit depreciation expenses in the P&L and credit accumulated depreciation under property, plant and equipment in the balance sheet. Okay, now we'll talk about the liability. Now we have a liability at the initial recognition of this particular lease, all right, lease liability. Okay, so how will we account it under subsequent years? So the entry should be debit lease liability when you get the lease payments. Imagine next year you are going to get 10,000 as your annual lease rental, right? So at that particular time you have to debit lease liability. So under lease liability for the second year, how much we calculated as per our earlier workings? We said it was 9,000, right? And the third year it will be 8,000, right? So the second year when you get 10,000, how much has to go to lease liability? 9,000 has to go to lease liability. And credit bank or cash, how much you are getting? 10,000, and you are debited 9,000. So there is a difference of 1,000 in the debit side, right? So where it has to go? It has to go to the P&L under interest expense. Okay, you got it, I think, right? So that is how we consider or we measure subsequent in the subsequent years a lease under the lessee's books. Now under the lessor's book, the initial recognition of finance lease has to be through the following method. The lessor should not recognize the asset under his property, plant and equipment. Instead, he should transfer this particular asset to a lease receivable account, okay, under his receivables. Now this is the initial recognition, and when the this lease receivable can be described as the net investment in the particular lease, which should be equal to which is said to be equal to the present value of gross investment or fair value plus initial direct cost of the asset. Now subsequent measurements, when he receives the payments, when the lessor receives the payment, he has to he is, for example, he is getting a check of 10,000, so he has to deposit that in the bank. So debit bank, credit net investment, but net investment to the extent of present value of the lease payment. So for example, if he is receiving for the second year's lease rental, which is 10,000 USD, the current value, as we discussed earlier, could be 9,000. So 9,000 has to be credited to the receivable, and 1,000 has to go to the interest income or finance income. Okay, so debit cash or bank, credit lease receivable, and credit interest income. That has to be the entry in the leaser's book. Now, while coming to the accounting of operating leases, it is much simpler as compared to the accounting of finance leases. So how to account operating leases under lessee's books? The transaction journal entry should be debit lease rentals or expenses and the P&L, and credit cash or bank. When the lease payments are made, the expenses hit directly, and the bank or the cash is credited, and no asset or liability is recognized in the books of lessee. Similar way, in the lessor's books, when he is getting the lease payment, what he will do is that he is getting a cash or check. For example, he is getting a check, so he will deposit it in the bank. So he will debit the bank and credit operating lease income, and the asset is recorded in the balance sheet or statement of financial position of the lessor, and he depreciates it in the normal way as with other assets.
So students, that is what we would like to discuss about IAS 17. Hope you have got some understanding about IAS 17 and its concepts. This is the first part of lease accounting standards. In the next session, we will discuss about IFRS 16 that has superseded IAS 17, and it is the financial reporting standard that should be followed at present. Till then, bye bye.